They stole your silver. That is the only way to describe what happened over the last 24 hours. If you watched the market yesterday, you saw a bloodbath. You saw silver crash 8%. You saw panic. You saw headlines screaming that the bull run was over. And you probably felt a knot in your stomach. You probably thought about hitting the sell button just to stop the pain. But today, Tuesday, December 30th, the truth has been revealed. Look at your screen. Silver is trading at $74.54. We are up $3.35 in a single trading session. We have recovered nearly 50% of yesterday's crash in the blink of an eye. This was not a market correction. This was a bear trap. This was a calculated algorithmic flush designed to do one thing and one thing only: to separate you from your position before the year ends. The banks knew that retail investors were leveraged. They knew that stop losses were sitting at $72. So they pushed the price down, triggered the stops, stole the shares, and then immediately reversed the engines. In this urgent market update, we are going to dissect the anatomy of this V-shaped recovery. We are going to explain why the liquidity crisis we discussed yesterday was a temporary phenomenon, one that created the buying opportunity of the year. We are going to look at the institutional window dressing that is driving this frantic buying right now. And we are going to prepare you for the final 24 hours of 2025. The trap has snapped shut. But if you are still holding, you are not the victim. You are the victor. Let's break it down. To understand the violence of today's move, you have to understand the psychology of the weak hand. Yesterday, when silver dropped to $71, the weak hands, the speculators, the tourists, the people trading on margin panicked. They sold at the bottom. They puked their positions because they couldn't handle the volatility. They provided liquidity. The banks need sellers to buy from. If JP Morgan wants to cover a short position, or if a pension fund wants to enter the market, they need someone to sell to them. But at $80, nobody was selling. The strong hands were holding tight. So the market had to crash to create sellers. It had to shake the tree to make the fruit fall. Yesterday was the shake. Today is the harvest. The institutions are scooping up the cheap contracts left behind by the panicked retail traders. This is why the price bounced so hard. There was no structural damage to the silver market. Samsung didn't stop making batteries. The mines didn't find a new deposit. The dollar didn't suddenly become sound money. Nothing changed except the sentiment. And once the sentiment washed out, the price snapped back to its fair value, which the market is telling us is well above $74. Let's look at the algo flip. Modern markets are run by computer codes called CTAs, commodity trading advisors. These robots chase momentum. Yesterday, when the price fell through $75, the robots switched to sell. They dumped billions of dollars of futures. This accelerated the crash. But today, as the price reclaimed $73 and then $74, the robots realized they were wrong. The momentum flipped back to bullish. So the algorithms had to reverse their trade. They had to buy back everything they sold yesterday, plus new long positions. This creates a double buying effect. They're covering their shorts and opening new longs at the same time. This is why we see a vertical green line on the chart. The robots are chasing their own tails, and the price is the beneficiary. We also need to look at gold. Yesterday, gold crashed $150. It looked terrifying. Today, gold is trading at $4,373. It is up $46. It's stabilized. The liquidity event in the bond market that dragged gold down is past. The Fed likely injected quiet liquidity overnight to calm the repo markets. With gold stabilizing, silver was given the all-clear signal to run. And because silver is the high beta asset, it ran faster. Gold is up 1%, silver is up nearly 5%. This confirms that the bull market dynamics remain intact. Silver leads on the way up. It crashes harder on the way down. If you can stomach the crash, you get rewarded with the surge. Now, let's talk about the physical floor again. I want you to think about the bullion dealer you use. Yesterday, when the price was crashing, did they lower their premiums? No, they raised them. Today, with the price ripping higher, are they lowering premiums? No. The physical market is telling us that $74 is the minimum price required to bring metal out of hiding. We are hearing reports that during yesterday's dip, smart money industrial buyers stepped in aggressively. They didn't wait for the bottom. They bought at 73, they bought at 72. They absorbed the selling pressure. This created a concrete floor. The paper market tried to push lower, but the physical buyers stood there like a wall. We will take everything you have at $72. And eventually the sellers ran out of paper. That is when the bounce began. So where does this leave us? We are trading at $74.54. We are right back in the middle of the trading range. The shooting star candle from Monday looks ugly, but today's green engulfing candle cancels it out. It tells us that the bulls are still in control. The bears tried to kill the trend, and they failed. In technical analysis, a failed breakdown is a bullish signal. It shows resilience. As we head into the final trading day of the year, tomorrow Wednesday, December 31st, the stakes are incredibly high. The funds want to mark the price up. They want to close the year at $75 or higher. They have 24 hours to do it. Expect them to push hard. They want to paint the yearly chart green. This is window dressing at its finest. They are putting makeup on the portfolio before they show it to the clients. And that makeup costs money. They have to buy silver to make the price go up. We are witnessing a battle between market structure and market fundamentals. Usually, structure wins in the short term. Fundamentals win in the long term. But right now, both are pointing up. The structure demands a high close for bonuses. The fundamentals demand a high price for supply. This alignment is rare, and it is explosive. So, if you held through yesterday, congratulations. You passed the test. The market tried to shake you out and you didn't blink. You earned today's gains, but do not get complacent. The volatility is not over. We are still in ghost week. The order books are still thin. We could see another swing tomorrow, but the direction of the primary trend has reasserted itself. The dip was bought. The crash was fake. The bull is alive. We need to talk about what happens tomorrow. Tomorrow is Wednesday, December 31st. It is the last trading day of the year. And in the world of Wall Street, this is the Super Bowl of manipulation. It is called marking the close. Hedge funds, mutual funds, and pension funds are judged on their performance as of the closing bell on December 31st. Their bonuses depend on it. Their fees depend on it. Their careers depend on it. If they are holding silver, they want the price to be as high as possible at 4 p.m. tomorrow. They have a financial incentive to push the price up. So, what we are seeing today, this $3 rally, is the beginning of the year-end markup. The big players are stepping in to defend their positions. They are buying futures contracts to ensure that the year ends on a high note. They are erasing the damage from yesterday to paint a pretty picture for their investors. This is legal manipulation. It happens every year. But this year, the stakes are higher, because silver is the number one asset class. Being long silver is the consensus trade for the smart money. They cannot afford to let it close weak. If silver closes the year at $75, it validates the entire bull thesis. It signals to the world that the breakout is real, so expect a battle tomorrow. The short sellers might try one last smash. But the long money has deeper pockets right now. They have the bonus pool motivation. Never bet against a banker trying to secure his bonus. Let's look at the technical damage from yesterday. Did the crash break the chart? Technically, we dipped below the 20-day moving average. That looked bad. But today, we reclaimed it instantly. In trading, speed matters. If you break a support level but you climb back above it within 24 hours, it wasn't a breakdown. It was a bear trap. It lured the bears in. It got them to short the hole. And now, with the price back at $74.54, those bears are underwater. They are trapped. They have to cover their shorts into the year-end close. This provides a built-in buyer of last resort for tomorrow. If the price dips, the bears will buy to cover. If the price rises, the bulls will buy to press the advantage. It is a win-win setup for higher prices. Now, let's go back to the gold signal. We mentioned gold is up $46. Why is this important? Because gold is the fear gauge. Yesterday, gold fell because the bond market scared everyone into cash. Today, gold rallied because the market realized the Fed will fix the bond market. The Fed put is back in play. The market knows that the central bank cannot allow a deflationary crash. So they are front-running the bailout. They are buying gold before the Fed announces the liquidity injection. And because silver is gold on steroids, silver is reacting 5 times faster. This correlation is your safety net. As long as gold is holding $4,300, silver is safe. The monetary floor is solid. If gold had continued to crash today, if it had dropped another $100, then we would be worried. But the stabilization tells us the liquidity crisis was a one-day event. It was a flash storm. The sun is back out. Let's discuss the January effect again in this context. With the price back at $74, silver looks attractive to the new money entering in January. It isn't overbought anymore because the RSI cooled off during the crash. It isn't oversold because the trend is up. It is in the Goldilocks zone. The technical indicators have reset. This allows the trend to continue for another month without overheating. The crash was actually constructive. It released the pressure. It allowed the steam to escape so the boiler didn't explode. Now we can build pressure again for the run to $80. We also need to look at the retail psychology. Yesterday, the comments section was full of fear. Is it over? I lost so much money. Today, the comments are full of relief. Thank God I held. I bought the dip. This emotional roller coaster is designed to exhaust you. The market wants you to give up. It wants you to say, this is too stressful, I'm out. But you have to resist that urge. Stress is the signal that you are in the right trade. If it was easy, everyone would do it. The fact that it is hard, the fact that it makes you sweat, means there is value there. You are being paid for your emotional durability. The weak hands sold yesterday. The strong hands are still here, and the strong hands are about to get paid. Let's look at the physical inventory numbers again. We talked about the dealer premiums holding steady. But let's talk about refinery output. It is the end of the year. Refineries are doing their annual audits. They're counting the bars. We typically see a slowdown in new supply entering the market in late December. This means the flow of metal is restricted. At the same time, demand is high because of the year-end hedging. Restricted flow plus high demand equals price spikes. The supply chain is the tightest it has been all year. There is literally no slack in the system. If a major buyer steps in tomorrow, they could gap the market again. We are operating without a safety net. We need to consider the geopolitical hedge going into the new year. 2026 is an election year in some countries. It is a year of potential conflict. Smart money does not want to be in cash when the ball drops. They want chaos insurance. Silver is chaos insurance. It protects you against war. It protects you against currency failure. It protects you against cyber attacks on the banking system. Buying silver on December 30th is a vote of no confidence in the geopolitical stability of 2026. And looking at the headlines, that is a very rational vote. The fear trade is layering on top of the industrial trade. It is a double-barreled shotgun pointing at the short sellers. So as we prepare for the final trading day, what is the strategy? Hold. Do not try to be cute. Do not try to scalp pennies. The trend is up. The fundamentals are screaming. The technicals have healed. You are in the driver's seat. If you have cash on the sidelines, any dip tomorrow is a buying opportunity. We established a floor at $71. That is your line in the sand. As long as we are above 71, you are safe. You can buy with confidence knowing that the industrial buyers are right behind you. We are going to wrap up this section with a look at the long-term chart. On the monthly chart, we are printing a massive green candle. Even with the volatility, we are up huge for the month. This is a breakout month. Historically, when silver breaks out of a multi-year base on a monthly time frame, it runs for 6 to 9 months without stopping. We are in month 1. Do not sell in the first inning of a 9-inning game. In the next section, we will look at the specific targets for January. We will calculate the measured move from this consolidation, and we will give you the final pep talk to get you through New Year's Eve without selling your position.